Welcome to this explainer, where we're going to completely decipher what the upcoming retail earnings reports are actually telling us about the true underlying health of the U.S. economy. Now, at first glance, sure, a corporate earnings report might just look like straightforward financial accounting, a bunch of numbers on a spreadsheet. But underneath all those expectations lies a much bigger and honestly a much more fascinating question. How strong is the American consumer really? We're going to use these upcoming reports as a real-time window directly into everyday household spending.
Okay, let's dive right into this massive number straight out of the gate, $186.8 billion. Now, I want to be incredibly clear here. This is not what Walmart actually made in profit. Rather, this is the staggering, almost unbelievable revenue that Wall Street expects them to report for their fiscal second quarter. It's a colossal figure. It represents an expectation of about 5.3% year-over-year growth, but it's so much more than just an earnings estimate. You see, because Walmart operates at such an absolutely enormous scale, this number is a direct reflection of what millions of everyday Americans are actually doing with their money right now at the checkout counter.
Section 1. The $1860 billion question. So, let's really unpack this $186 billion question. We are looking way beyond just the stock prices today. We want to see how these mega retailers serve as a real-time macroeconomic barometer for the wallets of American households. It's all about whether they meet, beat, or completely miss the growth trajectory that investors have already priced in. And the expectations here illustrate a really subtle test that Walmart is facing right now. Wall Street expects roughly 74 cents in adjusted earnings per share. But here's the catch. Delivering 74 cents just barely meets the absolute top of Walmart's own previous guidance of 72 to 74 cents. Plus, they need to hit about 3.8% in U.S. comparable sales. That's the growth at existing stores. If they hit these estimates, great. But if they miss them, well, that could signal some much deeper, much more concerning consumer weakness. The market is immediately going to ask, is this just a temporary hiccup, or is the economic environment fundamentally degrading for the everyday shopper?
Section 2. Walmart vs. Target. Now, looking at just one single company really only gives us half the story. To get an accurate read on consumer health, we absolutely have to contrast Walmart's performance with another retail giant, Target. And the crucial point here is the sharp, undeniable contrast between their customer bases right now. Walmart has a massive grocery operation, right? And they are currently benefiting heavily from what we call the trade-down effect. This is where higher-income households actually start shopping at Walmart specifically to save money on everyday essentials. Target, on the flip side, relies way more heavily on consumers wanting to buy discretionary, non-essential items, things like home goods, electronics, and apparel. So, if Walmart is thriving, but Target is really struggling, it tells us that households are still spending, but they are ruthlessly prioritizing their basic needs over their wants.
This whole dynamic shows us that middle and higher-income consumers aren't necessarily stopping their spending entirely. No, they're just becoming incredibly selective and laser-focused on price when it comes to where their money goes. We actually saw a perfect real-world example of this in recent data from Sam's Club. Their total transactions increased by 6.2%, which sounds great, right? But the average ticket size actually fell by 2.2%. Think about that. People are making more trips to the store, but they are spending less money on every single trip. It is a classic, undeniable indicator of consumers spreading their budgets out way more carefully.
Section 3. The e-commerce plateau.
Let's step beyond the physical store aisles for a minute, because we have to look at the massive structural changes happening in digital retail. This stuff is shifting the entire landscape, because today it's no longer just about foot traffic, it's about digital carts and massive fulfillment centers. Now, according to a really fascinating recent analysis by FTI Consulting, the epic era of unbridled, explosive e-commerce growth, it might actually be approaching a ceiling. For the last few years, especially during and right after the pandemic, digital sales growth felt completely limitless. But this new data suggests that consumers are now looking for e-commerce to be fully integrated with all their retail experiences rather than just replacing physical stores outright. Now, make no mistake, the digital numbers are still absolutely astronomical. Online retail sales in the U.S. are projected to hit a staggering $1.27 trillion in 2025. That is an 8.5% increase over the previous year alone. But here's where it gets really interesting. FTI Consulting points out that this massive total is largely being fueled by inflation and the pandemic's lingering pull-forward effect on our shopping habits. In fact, if you look at total retail sales from 2020 to 2024, they rose trillions above pre-COVID expectations. But here is the real kicker. A massive 40% of that growth, that was literally just inflation.
And despite those massive dollar amounts we just talked about, if you look at the market share progression, it's actually decelerating. It jumps from 21.6% of the overall market in 2023 to an expected 23.5% in 2025. But look at the projection for the end of the decade. It is completely expected to plateau near 30%. This tells us something huge. It means the direct-to-consumer revolution isn't over, but it has definitely evolved. Retailers just can't rely on endless digital expansion to save them anymore. They have to integrate their digital and physical presence totally seamlessly.
Section 4. The profitability contradiction.
So this brings us to a major conflict at the very heart of the modern retail sector. Generating massive sales does not always equal making a profit. And this right here is where things get really challenging for these retail giants. We have to ask, how do companies manage a historically low-margin business when they're faced with mounting unpredictable pressures from literally all sides of the supply chain? Take Walmart, for example. They saw their global e-commerce grow by 26% in their first quarter. That is incredible top-line growth. But digital fulfillment? It is notoriously expensive. Delivering items directly to doorsteps eats right into the margins that you would normally keep if a customer just walked into a store and took the item off the shelf themselves.
The reality is, even with incredibly strong revenues, a tiny spike in operational costs can completely obliterate earnings. And that's exactly why we must look underneath the headline numbers. Just look at these margin pressures. In Q1, higher fuel costs in distribution and fulfillment alone reduced Walmart's operating income growth by about 250 basis points. That's 2.5%, gone, just like that. Then you throw in changing tariffs, since both Walmart and Target rely heavily on imported goods. You add rising wages, and you add the desperate need to offer heavy promotions to cash-strapped consumers, and you can easily see why strong sales absolutely do not automatically mean strong profits.
So how did they survive this contradiction? Well, Walmart isn't just a store anymore. To combat this, they are aggressively offsetting these traditional retail margin pressures through high-growth, extremely high-margin areas. Just in Q1, their global advertising revenue jumped by 37%, and membership income rose by 27%. This pivot is absolutely vital. So when you finally see Walmart's bottom-line profit number, you have to remember to ask yourself, did they actually sell more groceries, or did they just sell a whole lot more ads and memberships to offset that retail margin compression?
Section 5. The final verdict. All right, as we prepare for these earnings to actually drop, we need a really solid, impartial framework to judge what the numbers are actually telling us about the wider economy. How do we separate the polished corporate spin from the gritty macroeconomic reality? Well, here is our framework. Let's start with the optimistic, bull scenario. If we see positive indicators across the board, revenue beating that $186.8 billion expectation, EPS coming in above 74 cents, really strong comparable sales, and, crucially, raised forward guidance from management, well, it strongly suggests that the household growth engine is fully intact. It would basically mean the American consumer is still remarkably resilient, absorbing all this inflation and elevated interest rates, and continuing to spend confidently.
Conversely, here is the pessimistic bear scenario that we need to watch out for. If revenue expectations are missed and margins continue to shrink, the broader market could interpret this as hard, undeniable evidence that the economic environment is simply becoming too difficult for the average shopper. If management comes out and sounds super cautious about the rest of the year, or if we see these retailers having to heavily discount items just to get them out the door, that is a severe red flag. It tells us that consumer spending might finally be hitting a brick wall.
So keep this little toolkit handy when the books finally open, because tracking the combination of these 5 specific metrics is really the only way to accurately read this real-time macroeconomic barometer. Revenue, that tells you raw demand. Comp sales, that shows you the loyalty and health of their existing customers. Margins, that proves if they can actually convert that raw demand into real profit. And forward guidance, honestly, that is the most important number of all, because it tells us exactly what the people running these massive companies see coming down the road for the rest of the year. Ultimately, these impending earnings reports aren't just a corporate scoreboard. They are the vital answer to whether the American consumer can actually keep the broader economy afloat. If shoppers are congregating at value-focused stores and heavily pulling back on discretionary items, they might still be spending, but with far less room to spare. The numbers underneath the big, flashy headlines are going to tell us the true story. So is the American consumer truly resilient, or just running out of room to spare? Thanks for joining this explainer, and keep your eyes peeled on those margins.